It's time to actually look at some financial statement transactions. As you know by this point, what we're doing with accounting is really identifying things that need to be measured. We analyze them, and then we report them to people who are trying to make decisions. So part of the bookkeeping process is identifying transactions, analyzing them, and then measuring them so that we can ultimately aggregate the results and put them in the form of financial statements, such as a balance sheet or an income statement. We're going to take a few minutes and go through some transactions in a few minutes and look at how we might aggregate them into various accounts. Now, keep in mind that at its core, every business, from the largest business that you can conceive to the smallest local coffee house or plumbing repair shop or something like that, all of them can divide their activities into operating, investing, and financing activities. Operating activities, as a reminder, are basically the day-to-day activities of the business. Operating activities are those things that we need to accomplish for the reason that we're in business. Investing activities involve the purchase and sale of long-term assets, and financing activities involve obtaining bank loans or other loans, repaying those loans, issuing stock to the owners, maybe paying dividends to those owners. Those are the basic building blocks here. Now, also, once we get past those basic building blocks, we have to understand what types of accounts we're dealing with. Ultimately, what we're going to try to do is for every transaction, we're going to have the transaction affect at least two accounts. It's the concept of double entry bookkeeping, and we will look at this concept in some more detail in a separate video. But before we talk about accounts, we need to understand these five basic areas: assets, liabilities, owner's equity, revenues, and expenses. And what we're seeing here, the assets, liabilities, and owner's equity, and while I'm drawing this, I should point out, I say owner's equity because that's a broad, general term for the measurement of the owner's equity. If it were a corporation, this would be called stockholders' equity. If it were a limited liability company, it would be called members' equity. A partnership would have partners' capital accounts. But broadly speaking, regardless of which type of entity it is, owner's equity gets the concept across. What I have here, this represents the balance sheet. The balance sheet really tells us what do you own and what do you owe. Assets are these wonderful good things, these resources that we own. Liabilities, these are amounts of money that we owe to our creditors, whether it be accounts payable to a supplier, wages payable to our employees, could be notes payable to a bank that has loaned us money. So we have what you own and what you owe. Then we have owner's equity. Owner's equity is the residual of the assets and liabilities, assets minus liabilities. It's the owner's claim to the net assets of the organization. Over here, we have income statement accounts, right? So what's happening with the income statement is we're measuring the results of the operations of the business for a particular time period, for a month, for a year, a quarter, something like that. We're measuring how well did the company perform operationally for this particular period of time. As we look at the relationship in recording these transactions, we need to look at the fundamental accounting equation. Assets equal liabilities plus owner's equity. And yes, I know, there's a very good chance that the textbook you're looking at says assets equal liability plus stockholders' equity. And that's just because the textbook is using a corporation as the form of entity for its example. We're going to broaden this for owner's equity. Later on, we will have an example using a corporation. So when you see stockholders' equity, don't be afraid that there's anything different. It's just owner's equity specific to a corporation. So at any point in time, as we record transactions, the assets of the entity will be equal to the liabilities plus the owner's equity of the entity. This identity will always exist, and it's really the basis of double entry bookkeeping. Now, let's expand owner's equity just a little bit. Because if we think about owner's equity, there are really two broad categories of owner's equity. And let me just kind of explain this. There is something called contributed capital. Now, contributed capital could be something like common stock as an example. You've probably heard of common stock. And so what's happening with contributed capital is the owners, the individual owners of the entity have contributed capital to the company in exchange for an ownership interest. So this represents money or other resources that the owners of the company have put into the company, their investment. The other major bucket is this concept called retained earnings. And I want to let you know right now, as you're studying retained earnings, if it becomes confusing, if it's a foreign concept to you, I believe that makes you normal. Because I can remember retained earnings being a confusing concept when I was first studying double entry accounting. So don't give up on yourself. Let's just persist if this is a kind of confusing concept to you. So owner's equity divided into these two major categories. There are some additional complications that we will introduce at a later point in our discussion, but for now, let's just use these two buckets. So we have contributed capital, retained earnings. Well, what's this concept of retained earnings? Think about earnings, first of all. Earnings are synonymous with the profit or the income of an entity. So retained earnings is the profits of the entity that have been retained within the corporation. In other words, those profits that have not been distributed to owners. At the end of the day, if you own some shares in a company, you're probably trying to achieve financial returns. And you could certainly maybe obtain a paycheck from the company if you performed services. You could simply wait for and hope for the company's value to increase so that you could sell your shares at a profit. That's possible. But some people would like to see distributions or dividends. So in other words, as the company generates profit, some of that can be distributed to the owners, and that's a return on their investment. Not a return of their investment, it's a return on their investment. You can think about it as being a bit of the reward for being an owner, for having tied up some of your capital into the entity. So owner's equity, and we're really looking at the retained earnings portion here, as the company generates profits from operating, that will be measured on its income statement. The bottom line of the income statement is net income. That's going to drive up owner's equity. It's going to make retained earnings get bigger. Now, as the company generates those profits, if the board of directors elects or makes a resolution to issue a dividend, they declare a dividend, then what would happen is, possibly, this is not a guarantee, if you're a shareholder, you're never guaranteed a dividend, but if it does happen, what would happen is the retained earnings balance would decrease, and that would be offset by probably a cash payment to the shareholders. So think about the accounting equation as we start to explore recording some of these transactions. We're getting closer to actually analyzing some of those transactions, but before we do that, I want to point out that transactions could be internal to an organization or they could be external to an organization. The pictures I've chosen here, you can see a warehouse. So a transaction that a business needs to record might be as simple as internally, they move some inventory from, let's say, raw materials and put it into production, so it goes into a different asset account called work in process, and then eventually becomes a finished good. Those are just a few basic examples of transactions that could happen within an entity that still need to be recorded because things are moving around internally. Of course, a lot of transactions are external to the organization. So let's say that you're an automobile manufacturer. You've had plenty of internal and external transactions to get to this point where you have finished goods, and now you're going to sell those goods to a dealer who will ultimately sell them to the end users. That represents an external transaction where you're dealing with a party outside of your organization. The basic process we're going to use is to take a look at transactions and, first of all, analyze the transaction. Figure out what's happening, figure out which accounts need to be affected. Do those accounts need to increase or decrease? And then we can record the transaction by increasing or decreasing the affected accounts. We're going to summarize those results, which we will see at the very end of this video. From that summary, we prepare something called a trial balance. And the trial balance is simply a listing of the accounts that an organization has and whatever related balances they have at that point in time. Ultimately, the reason for the trial balance is we want to prepare our financial statements. We want to prepare our balance sheet, income, statement of cash flows, and an owner's equity statement. Those are the 4 basic financial statements for external reporting. The trial balance is going to give us the summarized information that we need to be able to prepare those financial statements. Most companies use a chart of accounts to guide their transactions. And I like to think about the chart of accounts as just being a listing of buckets, really, where we can place certain transactions that are similar in the same bucket. Now, we're going to be looking at a company called Blake's Coffee House. Yes, full disclosure, that's my son's name. And I chose a coffee house because it's a fairly simple, relatable type of business. So there's not a lot of complexity. It will let us look at a few transactions without having to deal with a lot of technical issues. So here's a partial chart of accounts for Blake's Coffee House. There's nothing magical about this. There's no standard that says you have to have a certain account. It's going to be based upon your business. You want to think about what information do users need to be able to make financial decisions about your business. So I created this chart of accounts for Blake's Coffee House. What you can see here is that we start out with cash. Now, I just told you that every business is different, but also every business has a cash account. Many businesses have more than one cash account, like maybe an operating checking account and a payroll checking account, maybe a savings account. Maybe they have businesses in different geographic areas and they have to have branch accounts at different banks. But ultimately, we can just kind of look at this as cash. So let's take a look at this chart of accounts. There are account numbers that can sometimes be used for the actual bookkeeping process, whether you're going to identify an account by its name or by its specific account number. We tend to group similar accounts together. For example, if you look right here, these items right here are all liabilities. So I labeled those all in the kind of the 4,000 range for account numbers. There's no prescriptive rule. This could have been the 5,000s or the 4,000s or the 3,000s. The point is to make it logical for the organization. These are some of the accounts that we will be using to record the transactions of the business. And to just give you a little bit of terminology, we'll look at some of these details in more depth later on. But take a look here at current assets. Assets are the resources of the business. So we have current assets. What that means is a current asset is either cash, which we see right here, or it is expected to become cash pretty darn soon, like accounts receivable. Accounts receivable measures the amount of money that our customers owe us. So we hope that becomes cash pretty darn soon. Or it will be used up or consumed within an operating period. Prepaid rent is kind of a goofy concept where we actually paid our rent in advance and we did not treat all of it as an expense, so some of it stays on the balance sheet as an asset. We're probably never going to convert that to cash, but it is an economic resource that will be used up over time. And in this case, because we said current, it'll be used up within the next 12 months most likely. Now we've got a couple of non-current assets listed here. These are long-term assets, things that we will use to run our business, and we expect them to remain in place for a number of years. This accumulated depreciation is its own goofy animal, and we'll talk about that at a later date. Liabilities over here. Current liabilities, just like the current assets, are expected to be converted to cash or used up within 1 year. Current liabilities, we expect to have to satisfy those within 1 year. So you can start to get a little bit of a preview here. Financial statements are supposed to help users assess future cash flows. And you can see the little preview right here. We're grouping some of the assets in terms of, hey, what's going to be used up or converted to cash within a year? Resources available within the next year. Some of the liabilities, we're calling them current liabilities. These are things we're going to have to pay within the next year. So you can start to see the building blocks for analysis where we can analyze the short-term health of the company. Will it have enough resources here to satisfy the obligations that have to be satisfied within the next year? One of the liabilities here is not current. It's a long-term bank loan. We still owe the money, but whatever portion is non-current, that's due at some point in the future. Remember that owner's equity we talked about, the contributed capital versus the retained earnings? They're both right here. I call it stockholders' equity now because Blake's Coffee House is a corporation. Then we have from here on down, from beverage sales all the way down to this interest expense, these are your income statement accounts. Remember that the income statement is going to measure the results of the operations for a specified period of time. So as we look at whatever balances are listed here for beverage sales, food sales, which are revenues incoming from our customers, or for all these various expense accounts, that's going to help us be able to measure the net income or the profit that we generated for a particular time period. It's the time you've been waiting for. We're going to actually take a look at some transactions. Now, as we go through these transactions, understand that these are really oversimplified, but I'm just trying to illustrate some of the basic concepts. So let's think about a brand new company, and we're really looking at a brand new company here. So pretend that January of 2018 is this company's first month of operations. Think about a brand new entity. If you wanted to, you could form your own corporation within the next few hours. There are ways you could do it yourself, or you could go to an attorney and they could help you file articles of incorporation. And after you did that, and they were accepted by the state, you would have an entity, a corporate entity. But a brand new corporate entity is just like a baby that comes into this world. Penniless, it owns nothing. So a brand new entity needs to obtain resources from somewhere, because obviously this is a coffee house. We need to have an espresso machine, probably some kind of point of sale, computer, cash register, iPad, something like that. We're probably going to want some furniture, maybe some artwork, maybe an audio system for some ambiance. You get the point. Where does the entity get the money to be able to do that? Well, one of the ways is to issue stock to owners. So what's going to happen here? Let's say that the owners contribute cash, okay? So we're just going to say cash increases by $10,000 over here. And then what do they get in exchange for that? Well, they're giving up a very liquid resource, which is cash, but they're still getting an asset. They now own shares of stock. They own an asset called common stock. So from the owner's perspective, they have less cash now, but they still have a new asset called common stock. They converted some of this liquid asset into an ownership in a company. From the company's perspective, and keep in mind, when we record these transactions, we're really recording them from the perspective of the business entity. From the business entity's perspective, the business now has $10,000 in the bank. So its cash account increases by $10,000. And there's common stock that also increases by $10,000 because this is the owner's claim to the net assets of the company. If for some reason this company decided, you know what, we're going to fold. We decide not to run a coffee house, look what would happen. The company would write a check to the shareholder, cash would go away, common stock would go away, and the company would have no assets, liabilities, or stockholders' equity. As we look at other transactions, what you're going to see is this identity. Assets will always equal liabilities plus stockholders' equity. At this point in time, our assets are $10,000. Our liabilities are $0. And our stockholders' equity is, again, $10,000. So the equation stays in balance. So now the business has $10,000 in cash, and it can start to invest in its infrastructure so that we can eventually open up this coffee house and start serving customers. Let's say that they want to purchase a computer. And I'm going to use $300. I realize that that's probably not the world's most powerful computing machine, but apparently it will work for our point of sale system. So look what happens over here. we're going to buy a computer, so the cash account is going to decrease by $300. Now, assets still have to equal liabilities plus owner's equity. What's going to happen is we're going to use a long-term asset account called equipment, and that's actually going to increase by $300. So for this particular transaction, there's nothing affecting liabilities or stockholders' equity. All we're doing from the company's perspective is we're taking $300 of that cash that, yes, we obtained from the shareholders, and we're using the cash to buy a different asset called equipment. Total assets stay the same. They just change categories by the amount of $300. Those of you doing the math might know that we have $9,700 in the bank at this point. We started with nothing. Shareholders gave us $10,000, then we spent $300 to purchase that computer. Guess what? $9,700 is probably not going to be enough to get us to the point where we can turn on the open sign for our business. So let's borrow some money from a bank. What's going to happen here is we have the cash account, and that is going to increase by $20,000 because the bank loaned us $20,000. And now we have a new account here. It's called note payable, sometimes called notes payable. Occasionally it has other aliases as well. But what you're seeing here is now we are obtaining money, and it's not from our customers, so this is a financing activity here. And we're getting that from a lender, probably from a local bank, but it could be from a rich uncle or something like that as well. But what you're seeing here is still the accounting equation stays in balance. Asset called cash increases by $20,000. A liability called notes payable or note payable increases by $20,000. And now the company has an extra $20,000 in the bank. It can start to buy some of the other things that it needs in order to open for business. Now we have a little bit extra money from the bank, actually a lot of extra money, and we can start to invest in the rest of our infrastructure. So we need to buy an espresso machine. It is a coffee house. Now, I have one of these at my house. I did not spend $9,600 on my espresso machine because I don't make that many cups every day. But if you're going to be in the business of making coffee for people, you're going to need to spend some dollars. So let's assume that the company spends $9,600 to purchase an espresso machine. Now, what you might notice here is I have this asset account called equipment that's increasing because we buy the machine, we own it, and so the cost of that machine should be reflected in the equipment account. But I didn't do anything with cash. And you might be wondering, well, how do we pay for that? Well, sometimes what happens when we're conducting business with other businesses, they extend trade credit to us. So there's a current liability account. It's called accounts payable. And what this measures is the amount of money that we owe to our vendors. It's expected to be a pretty darn current liability. In other words, most businesses are going to satisfy this within 30 days, maybe 60 days. Because the reality is if you take too long to pay your vendors, they're going to stop supplying you with things, okay? So that's what we have here is that we did not use cash to purchase this espresso machine. Instead, we purchased it from a vendor that provided us with credit, and we essentially owe that $9,600 to the vendor. We're going to pay that, and you're actually going to see that transaction in a few minutes, but you can see that the identity continues here. Total assets increased by $9,600. Liabilities and owner's equity increases by $9,600, specifically because accounts payable is now bigger. It was really nice of that supplier to extend us credit for the espresso machine, but they're going to want some payment. Now, maybe in this case we don't pay them in full, but let's pay them $5,000 and start to think about what's happening there. If you have any difficulty knowing how to record a transaction, a really good starting spot can often be what would happen to cash, okay? Just pretend you're running this business and you decide to pay $5,000 to the vendor that sold you the espresso machine. Well, you know a starting point is going to be we spent some cash because we wrote a check or maybe we Venmo'd them some money or whatever. But either way, our cash is going away. So we know the cash is going to decrease by $5,000 because we're remitting partial payment to this supplier. Then you have to wonder, you look at this equation, you know it has to balance. So that means, well, maybe an asset goes up here, but I don't think so. We're not getting anything else in exchange. What's happening is the accounts payable is actually decreasing by $5,000. We used to owe the vendor $9,600 because they gave us a little time to pay for that machine. We make a partial payment. What's going to happen is our cash decreases and the liability to the vendor decreases by an equal amount. And now we only owe them $4,600. We're halfway there. Here's another transaction, but this is actually a transaction that we don't yet have to record in the financial statements. Our customers are going to need somewhere to sit, some chairs and tables and whatnot. So we place an order with a custom furniture manufacturer, and they're going to make us some really nice tables and chairs that really fit well in our restaurant. But all we did at this stage in the game is we placed the order. Okay? We know that there's going to be an obligation coming down the road, but we're not going to record that obligation until we actually receive the furniture. So simply placing the order is not a transaction that needs to be recorded in the financial statements. We really don't have anything happening here economically that causes our assets, liabilities, or our stockholders' equity to go up or down. However, once we receive the furniture, now we have an obligation. Let's assume this furniture costs $9,000. So we have the equipment account over here. And some of you might be thinking, well, equipment, furniture, yes. Some companies choose to use separate accounts. So they might have one account for their equipment, one for their furniture, one for other types of long-term assets, maybe like the building if they owned it. I'm just keeping things simple here for y'all. So the equipment account is going to have our espresso machine, the computer, and it's going to have the furniture there. It's long-term equipment. So we own this equipment. You guys know that the equation has to balance. Now let's say that in this case, we made a down payment on the equipment. So in other words, we paid $4,000 to the vendor when they delivered the furniture, but then the vendor provided us with credit for the remaining balance. So what we're going to see here, you remember how our accounts payable balance was zero, then it went up to $9,600 because of the espresso machine. Then accounts payable was reduced because we paid for part of the espresso machine. Now we have accounts payable increasing again because we bought a piece of equipment that cost $9,000. How did we pay for it? Well, we paid for $4,000 of those dollars using cold hard cash, and the remainder was essentially financed with our vendor on a short term using trade accounts payable. You can see that this will cause the accounting equation to stay in balance. The net increase to assets here is $5,000. Two different accounts, but if you combine those accounts, assets increased by $5,000 as a result of this one transaction. And liabilities also increased by $5,000. The equation stays in balance. One last transaction in this set of examples here. So we have the espresso machine, we've got a computer, we have the furniture. I think we need to start to get some inventory so we can actually sell food and beverages to our customers. So let's receive some inventory. New account here called inventory. Now let me explain. Inventory represents the cost of the goods that we are going to resell to our customers. So in the case of a coffee house, it's coffee beans, could be ingredients for baked goods like flour, sugar, eggs, things like that. It could be bottled beverages that you would resell to your customers. But this is going to be the cost of the things that we own that we intend to resell to our customers. Now, we could certainly pay for that inventory with cash, but a lot of times what happens, think about the delivery cycle. Somebody shows up from our vendor, delivers the inventory. Most cases, we don't hand them $100 bills or write them a check immediately, what will happen is our vendor is going to send us an invoice, and we're going to have accounts payable to our vendor. At some point in the future, I'm going to start abbreviating this as just AP. We'll keep writing it out for a little bit. So what you can see is that an asset called inventory increases. This current liability called accounts payable that we owe to our vendors increases. And the accounting equation continues to stay in balance. So this is the summarized step of recording those transactions. What you can see is each one of those transactions that we just analyzed, they're all listed right here. Issuing stock to the owners, purchasing the computer, borrowing money from the bank, buying the espresso machine, paying for part of the espresso machine, ordering and receiving the furniture, and receiving some inventory. And if you go back and rewind this video, you'll be able to look at each one of these transactions and see how they play into this tabular representation. Because what I have here across the top, assets equals liabilities plus stockholders' equity. We have 3 asset accounts, cash, inventory, and equipment. 2 liability accounts, accounts payable that we owe to our vendors, note payable that we owe to the bank that loaned us money, and stockholders' equity, common stock, which is that contributed capital, and retained earnings, which is where we will measure the profits that we earn once we start running the business that we did not distribute to the owners. Now, it's a brand new business, so your beginning balances are going to be 0 for these accounts. What we're going to see, look at the cash account. The cash account had the largest volume of transactions, and by the way, that's very typical for a business, which should make sense. So we have the increases and decreases. One thing I want to point out right here, and this is just one of the quirks of accounting that you get used to. A lot of times accountants will depict a negative number or a subtraction with parentheses. So when you see 300 in parentheses, that's cash decreasing because we bought the computer. 5,000 in parentheses, that's cash decreasing because we made partial payment to that supplier. At the end of the day, at the end of this month, our cash balance is $20,700. If we needed to prepare a balance sheet, all along the bottom here, we have the building blocks. A balance sheet reports your assets and your liabilities and your owner's equity at a particular point in time. Everything is right here. Okay? These 3 assets, cash, inventory, and equipment, are equal to these 2 liabilities plus owner's equity, which is really just the common stock account at this point in time. Now, where we're going to go with this next, I always start with just this fundamental increasing and decreasing because you can really make a relationship with your personal checking account. You guys watching this video probably have some kind of personal bank account, and you know that when you have payday, your cash account increases, and when you have to pay rent or other expenses, your cash account decreases. That's all we've done right here. And then we've done similar types of effects for these other accounts. Where we're going to go with this next is we're going to take a look at these exact same transactions, but instead of recording them with pluses or minuses, what we're going to do is we're going to use double entry bookkeeping involving debits and credits to record the increases and decreases to these particular accounts.